Amit Agarwal, Group CFO, Raymond Limited and Raymond Lifestyle. Mr. Agarwal, thank you so much for speaking with us here at NDTV Profit. Great to have you on. Let's start with how you are looking at this quarter with the demerger still in play.
Yeah, thank you for having me. And actually, if you see the Raymond Limited, which is demerging its real estate business, and from tomorrow that would be ex real estate, the Raymond Limited. And I think if you look at the performance of our real estate business, it has come out very, very strong. We have delivered more than 2,300 crores of sales, 500 crores of EBITDA. And if you see the JDAs, we have been able to put together another close to 7,000 crore of JDAs in this quarter. So overall, our JDA numbers reaches to 15,000 crores. So the portfolio which Raymond Realty has is around 40,000 crores, which will get executed over the next 5 to 7, 8 years. I think that way Raymond Realty is on a very, very strong wicket, executing its plan very well. And that is the need we thought is most appropriate, that one should get the Raymond Realty listed on its own, pure play business. And as your colleague pointed out, that for every shareholder who is holding one share of Raymond Limited will get one share incrementally of Raymond Realty. And we had done the demerger of the Raymond Lifestyle last year. In September, Raymond Lifestyle got listed, where the shares, for every 5 shares of Raymond Limited people were holding, they got 4 shares of Raymond Lifestyle. So that's where you have, as a group, 3 listed companies, pure play businesses, Raymond Realty with real estate business.
Let's do it this way then, Mr. Agarwal. Let's look at the individual verticals one by one, because that would give most clarity to our viewers on how these individual businesses are performing. And of course, they will then going forward have an opportunity to have participation in each of them as 3 listed verticals. Let's talk about Raymond Lifestyle first, because the quarter is showing pain. Now, take us through that. Is this a demand depression that you're seeing? Do you see that continuing? What has not worked for Raymond Lifestyle this quarter?
Sure. So look, Raymond Lifestyle, if we all know, in India for last 18 months or so, the consumption has been weak across sectors. And that has been clearly reflected in the Raymond Lifestyle performance for the entire year. And especially in this quarter, we were impacted by the ransomware, which impacted our operations almost to the tune of 24, 25 days. And which is almost like a 1/3 of the quarter was really impacted. But we were able to recover back a lot of sales, and we expect some of the sales to be recovered back in the 25-26. Second, the good aspect is that we are seeing a slight recovery in the demand, as we saw the secondaries in the various sectors, be it the wedding and so on, have seen a little recovery. However, our dealers, franchisees were a bit anxious to buy the products at this juncture, and they were feeling let the inventories come down and then they would start buying. If I look at the bookings, which we just started, we have seen a decent number to come in, but it is little too premature to say that the whole year we will have a strong demand coming on our way. But as we saw in the budget, there was this 1 lakh crore which was distributed, which was given the tax possibility for the people. So that will go typically in consumption. And we see there is a slight uptake with the interest rates going down, inflation coming under the control, people will go out and start spending. So we see definitely a 25-26, a better year compared to 24-25, which was an exceptional year where the demand was very, very weak.
So there was this ransomware attack, demand was weak, other expenses also were up. So this is on Raymond Lifestyle again. What does this other expenses comprise of? And are these now one-offs or continuing, entries?
So look, what happens is in this quarter, we put more advertisements, as we saw the secondaries were doing well. So we put more advertisements because we wanted also our dealers and franchises to come down. Second, when you put up the stores, as I mentioned, your colleague mentioned, we have been able to put up more than 350 stores in the last 3 years. And now what happened? If the demand would have been normal, they would have started to show a good break-even, a positive territory on those stores. However, because the demand scenario was low, the stores are taking little longer in terms of showing the break even and becoming profitable. So we believe with our focused effort on marketing, advertisement, sales promotion, we should be able to get back and start getting a better productivity. And we all know that when you make so much stores, every store would not do well. So we are also starting to see that some of the stores, maybe 10 to 15%, we would rationalize also in this year. And therefore, we will take forward and improve the productivity of these stores. So this is like one-off expenses which had impacted the quarter, and going forward, as the productivity of these stores starts to improve, then we will see a better result from these stores as well.
Okay, let's come to the engineering part of the business now, which henceforth will sit primarily and entirely in Raymond Limited, right? What has been the outlook for there? Because you've seen revenue impacted as well. Is this due to sluggishness in the export markets?
Yes. So what happens if I would like talk about our engineering business? These are three components. One, auto components. Second is the aerospace defense, and third is the engineering consumables. So if I look at it, auto components, we export almost 65% of the products to the European and the other export markets. We clearly saw between the third quarter and the fourth quarter, there has been a dip in the very clearly in the export markets. Domestic markets did well, so we were able to get there better. As far as aerospace defense business is concerned, we all know till third quarter, one of the major aircraft manufacturer had a very severe labor issues and their supply chain was disrupted. So we also got impacted. But if you look at it, the fourth quarter, it has come out very, very strong numbers. And based on our order book, we see the aerospace and EV component sector that we are seeing much stronger numbers coming out on our way. As far
Order
as the
book,
engine,
what is the order book in aerospace, and do you have a guidance for order book in the aerospace components?
so actually, we take a order book which is spanning as a broad order book for the 4 5 years. You
Okay.
cannot go out specifically to say in this year I would be able to deliver X, Y, G, because of a simple reason. People shift little bit here, they increase in some quarter, reduce in some quarters. So effectively, what we are seeing very clearly in the engineering business, minimum of 15% growth to 20% growth we are seeing in the engineering business across the board.
And what is the current size of the order book?
So you would not be able to say that it is specific to one order book because we have frame contracts which run into 4 5 years.
Okay, okay, fair enough. Let's come to the real estate business, and I think that's where all cylinders are firing.
Yes.
If I'm not mistaken, on a consolidated basis, what is the revenue contribution of real estate now, and what is the growth that you see for the real estate business?
So if you see 25, we delivered 2,300 crores of revenue, 500 crore plus EBITDA, and we have got a lot more launches going planned in this year. So that will enable and push the revenue forward. Again, in this business, we have given clearly the guidance that it will have more than 20% growth year on year. And as I've spoken earlier on your channel, that we believe in the next 3 years, this revenue can easily hit 4 to 4,500 crores over the next 3 years. And the EBITDA margins are decent, and we are not putting big capital because our whole model is sell fast, build fast, and collect fast. So that enables us to remain a debt-free business. And that is very, very important philosophy. And we all know that the group has decided very clearly that we are not investing in the land. There's a lot of JDA opportunities which will enable us to get a better return on capital employed on a go-forward basis.
In terms of margin outlook, and I don't know to what extent you're comfortable giving us a guidance, Mr. Agarwal, margins for the real estate business specifically, you saw about 25% in this quarter, if I'm not mistaken. Are you staying put in that range? Do you expect that range to sustain?
So we believe that's the right range to be there. Some marginal improvement we expect, but ballpark, we believe that is the margin we would like to maintain. Because we have a good mix between a Thane and a JDA project, and that ensures that the margin stays around this region.
What is the expansion looking like for this particular business in terms of GDV value as well?
So look, We have got Thane land, which is 100-acre land, where we are constructing right now 40 acres, which is almost 9,000 crore worth of projects being executed. Still potential of going another 16 or 1,000 crores on the 60-acre land, which would get developed maybe possibly over the 8 years or so. And if I look at the JDAs, which we have already signed to the tune of 14, 15,000 crores, where again, it is a horizon of 5 to 6 years. So clearly we have a potential of 40,000 crores, which is already signed, closed, which would get executed over the next 7, 8 years. So that itself gives you at least 5,000 crore per revenue. But you will continue to sign more and more JDAs, and that is the philosophy of the company. So if I look in this year, we have signed more than 10,000 crore worth of JDAs. So that ensures that as a business, we have a right model in place. People are picking up. And if I look at the JDA opportunity in Mumbai itself, we on a ballpark number, it's a very, very large opportunity. Practically every building, every third, fourth building is going to be redeveloped. And that is exactly our raw material, so to speak, in order to take forward this business.
The only I would say, I get your point completely, Mr. Agarwal. The only, I would say, downside of the redevelopment model or the JDA model is, licenses, clearances, and all of the bureaucratic red tape that it sometimes gets stuck in. Have you faced that thus far? What is your strategy there? That's a bit of an uncertainty if I look at it from an investor point of view.
Sure, but you see, fundamentally, what we do is when we sign a JDA project, we are very clear we are not putting in money for the project till such time we have got practically all approvals on a go forward basis. Absolutely, very, very clear. So, our plan is very clear. We have a partners in the JDA projects who will ensure that the approvals get placed and help us in terms of moving forward. Otherwise, we are not putting the money. So you look at the Bandra, which we have launched the project in Nirmal Nagar. What we did was we got it signed, we got all the approvals, and then we started the project. And from thereafter, our philosophy is very simple. Once you get all the approvals in place, you construct fast and sell fast. And that is clearly demonstrated in the Nirmal Nagar project, which was again an SRA project where we got all the approvals, started the project, sold very well. Almost 40% of the project is already sold. And we are coming up with the basement, 3 basements is coming up the ground.
Okay.
So we feel confident, we remain confident on achieving this.
All right. Raymond has a strong set of numbers. Lifestyle has had a weak quarter, but the outlook for this financial year remains positive. Thank you so much, Amit Agarwal, Group CFO, Raymond Limited, and Raymond Lifestyle, for that extensive conversation on the outlook for the 3 verticals of the business which are now being demerged.